travel isn't just about destinations, it's about the people you meet, the cultures you immerse yourself in, the stories you carry home. I'm Relebogile Mabocha, and on my travel feature, I take you on a journey beyond the guidebook. Each week, I connect with fellow travelers, insiders, and storytellers to bring you the heart of every place. Whether it's a hidden gem right here in South Africa or a dream destination abroad. Join me as we travel through conversations, memories, and inspiration. Listen wherever you get your podcasts.
The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram's a certified financial planner at Galileo Capital. The subject tonight, mixing shares and bonds in our investments. Warren, good evening. I think it's fair to say that when things are going well in the stock markets, it's quite tempting to keep it all in shares. Tonight, you're going to tell us why not.
Yeah, you're right, Stephen. I think when especially when they've gone well for a while, we tend to start feeling rather clever with ourselves and impressed with how we can make so much money by just letting our stock market investments run and run. And it becomes an easy game, this investing thing. These runs in the stock markets can carry on for quite some time, sometimes up to 5 or 6 years. And it can lull us into a sense of false security where we think, we're going to get rich, we're going to get to retire quickly. And all of a sudden, one day, the wheel turns and everything stops. And we won't know why that happens. And usually it's not going to be something we can foresee. We wouldn't have been able to foresee, for example, the financial crisis that happened in 2008, the drama that actually unfolded. We might have enjoyed the long stock market ride from 2001 to 2007, and maybe we were a bit worried about share prices being expensive and the like. But the dramatic, almost stop of the stock market and then the fall off the cliff would have caught most people, if not all of us, by surprise. And I think it's important that we know that when we're investing in shares and it's going well, it's very easy to become complacent. And when that happens, people like me saying, hang on, just be careful, spread your investments across different types of assets. We start to sound like a stuck record and people think you're kind of old school now and fuddy-duddy, etc. And until the market does take a big hiding. And I think we all saw that firstly in COVID, and then a year and a half later when the interest rates went through the roof and stock markets fell out the bottom. So the answer is we've got to be very careful. We need to be in the stock market. It is the best place to get good capital growth over a long period of time. But if we don't spread the risk, and especially adding in government bonds, we get to a situation where we could see dramatic losses in our money.
Okay, so when markets crash, all sorts of things happen, and we've seen a little bit of evidence of that quite recently. That obviously does terrible things to your investments.
It does. So maybe to give you context, because I think what I've realized is, as human beings, we're not very good at understanding percentages. So let's just say we've done well and we've built up an investment in the stock market of 5 million rand, and we were very happy with life. In a typical market crash, so not an extreme market crash, but a very typical market crash, you would see the stock market lose about a third of its value within the first year of a big crash. So if you've got 5 million invested, that means by the end of 12 months, you're sitting on 3.3 million rand. And for most South Africans, just the loss is more than they'll earn in a very long period of time. So it's not a loss. That size of loss is not something that most people are built to deal with. It's a psychological ability to tolerate risk, and very few people are able to deal with that kind of size drop. So what happens, and it happens almost en masse, is most people who are entirely invested in the stock market, after a big drop like that, won't stay invested. They won't ride out the storm. They'll actually sell out. And they get to the point where their tolerance for losses and their tolerance for listening to the argument to be patient, etc., gets to breaking point, and they sell. And usually what happens is they transfer the money that was in shares and they put it into cash. and hope for some form of interest just to stop losing money and maybe that they start to get a little bit of growth on whatever they've got left behind. And unfortunately, it seems we're very good sort of anti-predictors as a market. When investors do this en masse, we tend to make that big switch just before things start to recover. And so the tragedy is that people sell out and then the market starts to recover. It takes about 2 years for those losses to be erased. And in all that time, the people that sell out are sitting in cash waiting for things to get better. And the way that they judge that things are getting better is because, you and me, for example, will be talking about the stock market starting to recover and companies are reporting better profits again, et cetera, et cetera. And by the time that filters through to all the investors that have sold out, they've lost out on all of the recovery of the market and then might be tempted to go in again. And often they go in just before the next big drop. So it is a vicious cycle when you entirely invest all your money in shares and then don't ride out the very bad times.
Okay, and I mean, obviously it's difficult to know exactly what's going to happen. All right then. So when you mix your shares with bonds, how do you actually do it? I mean, what changes?
What happens firstly is that the losses get limited severely. So instead of losing, your 5 million going to 3.3 million, if you've got a classic mix of 60% in shares, 40% in bonds, suddenly that drop goes from 5 million to 4 million. And for some reason, psychologically, most of us can tolerate a loss like that. And that's the critical point here is it's about what we can deal with. None of us like losing money and none of us are going to be very happy when we see our statements. But where is the point where we can actually stay invested and ride out the drop so that we can participate in the recovery again? And it's somewhere around that 20% number for most of us as human beings. And it's not really related to our financial literacy or financial education or even how bright we think we are. It's just the inbuilt psychological tolerance for risk. And for most of us, that's the number. 20% is the drop that we can deal with. So on 5 million, we can tolerate a million loss. And so that is really why most of the very big retirement funds and big balanced unit trusts will try and aim for that balance of 60% in shares and then the balance in bonds. The risk management can get a bit better, especially when we start to say, why don't we allocate half of the investment overseas as well, and then in a very similar mix, in 60% shares and 40% bonds. And if we do that, what we find is when the markets, especially globally, have a big crash, the losses are a little bit less severe for us in South Africa because what happens is the rand acts like a really nice shock absorber. So instead of losing 20%, we end up losing somewhere around 10 to 15%. So even our beloved rand actually does have some benefits for us in a situation like this. So that 60-40, Stephen, is very simple. 60% shares, 40% bonds, ride it out, and then your losses get a lot less. Your recovery might take a little longer, but the point is you actually form the ability to stay invested. And that's really the whole key to this whole business is how long can you stay invested and let your money generate the money babies that we need to get that compound growth?
How do we end up with the balance of 60-40? Why does it seem that the classic portfolio is 60% of your money in shares and 40% in bonds? I mean, I presume it's classic for a reason.
It is, and it's because it's almost the most the largest amount we can have in shares. So in an ideal world, if we all operated like robots and we didn't have emotions, we would remain 100% in shares all the time and wouldn't be affected by the drops. But because of the psychology of human beings, the 60% is pretty close to the maximum that most of us can tolerate before we get very uncomfortable during a big market crash. And so, I guess it's an iterative process over time. Fund managers and investors have found that this is the point where we can tolerate the losses and still benefit from the growth. So it's almost, if we were building a car, 60% is the size of the engine. That's the biggest engine we can possibly put in the car before the brakes and the suspension and the shock absorbers and the airbags fall apart. And that's the 40%. So bonds, the thing to understand about bonds, especially globally now, is that bonds tend to move in the opposite direction to shares. So when shares are doing very well, bonds are not going to be such a good performer. And then we'll really be unhappy that we've got a bond exposure at all. But when the world falls apart in the stock market, then you see the price of bonds go up. And a rising price is very good for investors. It's the shock absorber that helps at least to limit the losses, or sometimes it actually makes some money. And that's really what we're seeing now on the international markets is bond prices are generally rising because interest rates are generally falling. So even though the stock markets are responding very badly to Trump every time he opens a social media account, the bonds are giving a lot of stability.
Okay, so the bonds give stability. I mean, I keep seeing stories about how bond yields are up, and that surely means that people who are buying bonds are very worried as well. I mean, there's a lot going on at the moment, and shares and bonds are both being affected.
They are. And so when you see a bond yield going up, the maths gets a little bit complicated here, because that means that actually the price is falling. And that's because investors, maybe just to talk about America for a second, because it's really in America where we're seeing this happen. And what's happening in the States is investors are getting a little bit worried that America might not be able to service all of its debt. And so they're not buying the new bonds that are being issued by the American government. And so the price is falling. And that causes the interest rates to rise. And the American government desperately wants interest rates to be low because they have to keep paying back all the debt that they've taken on. And so they want the price of bonds to be high and the interest rates to be low. That's not happening right now. And one of the reasons is around the tremendous instability that Trump has brought into the markets. Every time he opens his mouth about 50% tariff on Europe, or he attacks the Reserve Bank governor in America, the Federal Reserve governor, he causes instability. And that's actually really bad for bond prices and counterproductive to their whole strategy. But in general, because you can now earn a nice interest rate on bonds, it has become a very nice diversifier away from the stock markets again, which wasn't the case from 2008 all the way until kind of early 2022, when interest rates were pretty much zero and bonds were a terrible place to invest.
Personal finance this evening with Warren Ingram, taking your calls for him as well, as always, on 011 883 0702 and 021 446 0567, particularly on tonight's topic around mixing bonds and shares, how to get the balance right. So taking your calls on that this evening. We do have a question from Carol tonight, Warren. Carol asks, what will happen to the South African stock market if we lose a goer? Will our shares implode? Such a pertinent question at the moment, and it seems to me we should really price in whatever the consequences of a goer are going to be. More from Warren in just a moment.
The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram, of course, is a certified financial planner at Galileo Capital. 011 883 0702 and 021 446 0567. Questions from Carol asking, what happens to the South African stock market if we lose a goer? And Warren, I think we should prepare for the worst, frankly, when it comes to a goer and trade with the US.
I agree that the likelihood that the whole of a goer goes south for us is real. I guess the follow up to that will be what sort of trade deal will we sign with America, and will we get? I don't think we'll get a better deal, but what will be the impact? And when you listen to the economists, it's quite interesting that some of them feel the impact will be totally, or it's already overstated. In other words, people are making it sound a lot worse than it actually will be. And other people, I know Johan Rupert was one of them, saying it would be devastating for the South African economy. And I think this points to how difficult it is when you're making predictions, because no doubt if we lose a go and we don't get a good trade deal, it's bad news for South Africa. It's bad news for the companies that export products to the States. And I guess car manufacturers who export to America will be quite severely affected. However, what we don't know already, and I think that's the point, Stephen, in something like this, is we don't know what's in the price of the shares and the investments in South Africa already. There are fund managers and big pension funds that have the same sets of news that you and I have, and are paying for forecasts and political predictions, etc. And all of that filters back into the price of shares and bonds and other investment instruments that we can buy in South Africa. So, when someone like Carol's asking the question, it's a very valid question. But the follow-up is, if you're looking at this, what you're actually trying to anticipate is, what has everyone else thought about this, and what have they done to the price of investments already? And then what will they do when the news comes out? If the news isn't as bad as they feared, will prices rise? Or will the news be worse than everybody feared because they actually were a little bit too optimistic? And I think very quickly you can get yourself into a massive sort of circular analytical process where you actually don't really get a great answer. And so you get more and more confusion. And to me, in a situation like this, we do need to realize a lot of the businesses that trade on the South African Stock Exchange, they don't necessarily sell a huge proportion of their products to the States, but they do sell a lot of their products all around the world. And they're already adapting as fast as they possibly can to the changing environment. They might not all be getting it right, but certainly they're not going to just sit there and do nothing and watch their businesses implode around them if they can find new markets or new ways to trade. So I would be very careful of selling out of the JSE simply because of something like AGOA. I think a lot of it's in the price already, and I don't think we've got. I don't think almost any good news in the price of shares in South Africa. And all we need is something like the grey listing to be reversed, which might well happen by the end of this year, and a few pieces of good trade news with other continents, forget about just other countries, and we might be in a position where we're better off than we thought. So do I sell out of the whole JSE in anticipation of AGOA going away? I don't think so. I think that would actually be a bit of a mistake.
Yeah, I mean, I think a lot's going to happen and a lot's going to change, and I'll be very careful to sort of overreact. And the other thing to remember, of course, is that the whole world's in the sort of same position with the US economy. When we sort of just going back to our bonds and shares scenarios, we talk about a sort of balanced portfolio. When you're looking at the balance between bonds and shares, you say classic portfolio is 60-40 shares, bonds. Does it matter how old you are? Does this sort of mixture change depending on where you are in your kind of investment? I nearly said journey. I hate that word. Investment cycle.
It does matter very much. Your age is a huge factor. So when you're in your early 20s and you're at the start of your career, or if you're very lucky and you're even younger than that and you're getting some help from family to invest, then you really should try and go as much as you possibly can into the stock market. So if you can, allocate all of your investments into the local and the global markets and almost just ignore the crashes as they come. And the reason for that is you've got so much time on your side that worrying about a crash when you're 22 and you've got another 30-year career to come or longer, it just doesn't make sense. And you're in the very early stages of your earning and your saving, and so the crashes there are not happening very close to your retirement, and hopefully you can get yourself through the psychological pain of seeing the losses. Actually, what you really should do is if those big crashes happen early on, you should try and save even more into the markets because you're getting a great price for very good investments at that have just been discounted. But if you're older, especially if you're going to be living off your investments, if you are retired already or about to be retired, that 60-40 split is really helpful because bonds pay a very nice rate of interest. And so they become a very good source of income when you need an income. And then you get the growth from the stock market to give you that inflation protection. So I think age is a big factor. At the same time, if you're 67, I wouldn't now be reducing my exposure to the stock market below the 60%. Because if you're 67 years old, you might well live, comfortably into your late 80s, early 90s, and you still need the growth of the markets to help you with inflation protection. So aiming for that 60-40 split by the time you get close to retirement, I think is ideal. And then almost all the way through retirement, you maintain that balance for as long as you possibly can, and don't get too tempted to reduce your allocation just because of the volatility. We have to live with volatility now.
Very interesting. Warren Ingram, thank you as always. Certified financial planner at Galileo Capital on personal finance tonight.